All right, today we are diving deep into the vaults of the world's biggest financial players. We're talking about how they handle crypto on an institutional scale and the two major competing technologies that make it all possible, multi-signature and multi-party computation. Let's get into it.
So let's just start with the biggest question on the table. If you're managing, say, $1 billion in crypto, how in the world do you keep it safe? You obviously can't just give one person the master key. I mean, what if they quit? Or get hacked? Or just decide to, walk away with everything? This is the core problem that absolutely had to be solved before any serious money could even think about touching digital assets.
And the whole issue comes down to this one thing, the single private key. In the crypto world, this one little string of data is literally everything. It's not a password you can just reset. If you lose it, or if someone steals it, the money it controls is just gone forever. For you or me, that's a nightmare. For a massive institution that has a duty to protect its clients' money, it's a total non-starter. This single point of failure was the roadblock.
And that leads us to the very first big breakthrough that tackled this problem head-on, multi-signature security. You'll usually hear it called Multi-Sig. This was really the first viable answer for creating institutional-grade security in crypto. The idea behind it is actually pretty easy to wrap your head around. The best analogy, and this one comes from BitGo, is to just picture an old-school bank vault. You know, the kind that needs multiple people with different keys, all turning them at the exact same time to get the door open. No single person can get in by themselves. That, right there, is the core idea of Multi-Sig.
So what that really means in the digital world is that instead of one private key controlling all the funds, a multi-sig wallet needs multiple, totally separate private keys to sign off on any transaction. It spreads that control across different people, or different secure devices, or even different physical locations. It completely shatters that single point of failure.
So here's how it plays out in the real world. A super common setup is what's called a 3 of 5 wallet. That means you have 5 total key holders, but you only need any 3 of them to approve a transaction. So someone starts a transaction. Key holder number 1 signs off, then key holder number 2 signs off. But nothing actually happens. The funds don't move until that third person, that threshold, provides their signature. Boom, the threshold is met and the transaction goes through. It builds in both security and a backup plan.
But honestly, for the big institutions, the real killer feature of multi-sig isn't just the security, it's the transparency. Because every single one of those signatures is recorded right there on the blockchain for everyone to see, it creates this perfect, permanent, unchangeable audit trail. You can bet that regulators and compliance departments absolutely love this. They can see exactly who approved what and when they did it. It fits perfectly with how corporations are already structured. Okay, now let's fast forward to the next stage in this evolution, the newer kid on the block, Multi-Party Computation, or MPC. Now, if multi-sig is like a vault with a bunch of different locks, MPC is, well, it's a completely different way of thinking about the problem.
With MPC, you still effectively have one private key, but, and here's the magic, from the very second it's created, that key gets mathematically obliterated into tiny pieces, or shards. These shards get sent out to different devices or servers, and, this is the most important part, the full, complete private key is never put back together in one place. Not for a single millisecond, not even when it's signing a transaction. Think about that. One key, just mathematically, shattered. Each little piece is totally useless by itself, but working together, they can perform this cryptographic magic trick to sign transactions without ever revealing the whole secret.
And that really gets to the core difference here. Let's just boil it down. With multi-sig, you have multiple, separate, whole keys, and you need a certain number of them to sign something. With MPC, you have multiple pieces of just one key, and those pieces talk to each other to create a single valid signature.
This completely different approach gives MPC some really powerful advantages. First off, it's protocol-agnostic. What does that mean? It means it works on pretty much any blockchain out there. Bitcoin, Ethereum, Solana, you name it. That's because the final signature just looks like it came from a regular old single key. It also gives you incredible flexibility. You can add or remove signers or change the rules without having to move billions of dollars to a whole new address. And finally, the signers are invisible on the blockchain, which adds a layer of privacy that multi-sig just doesn't have.
All right, so we've got these two powerhouse technologies. How do they really stack up when an institution has to make a choice? Let's get into the showdown.
This table really nails the key trade-offs. Multi-Sig's logic is all on-chain, meaning it's baked right into the blockchain's code. That's why it's so auditable. MPC's logic is off-chain, It's like a private cryptographic meeting that happens before anything touches the blockchain. That's what gives it its privacy and flexibility. So you see, a super-regulated bank might lean toward Multi-Sig because that audit trail is rock solid. But a fast-moving crypto trading firm, they might prefer MPC because it's so quick and works across all the different assets they're trading. It really comes down to a choice. Do you want rigid transparency or flexible privacy?
So look, why does this nerdy battle between two cryptographic protocols matter to anyone who isn't running a bank or a hedge fund? Well, it matters because this is the very foundation that the entire institutional crypto market is built on.
When you see a headline about a company like BitGo offering a $250 million insurance policy on digital assets, that insurance policy only exists because these underlying technologies, Multi-Sig and MPC, provide a level of security that an insurance underwriter can actually look at, verify, and trust. Without this stuff, insurance at that scale would be a complete fantasy.
At the end of the day, Multi-Sig and MPC are not just cool features. They are the essential infrastructure, the roads, the bridges, the plumbing that turns crypto from a risky gamble into a legitimate, institutional-grade asset class. They provide the guardrails and the governance that anyone managing serious money absolutely demands.
And that leaves us with this one big question for the future. The security problem of that single point of failure. It's pretty much solved. But the next phase of institutional finance in this space now comes down to a philosophical choice. Is the market going to demand the absolute ironclad on-chain transparency that you get with Multi-Sig? Or will it lean into the privacy and the incredible operational flexibility that MPC offers? The answer to that is going to shape how the next $1 trillion flows into digital assets. That's it for this one. Thanks for tuning in.